Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures pushing higher this morning. That's after the U.S. and European Union reached a trade deal. The EU will accept a 15% tariff on most of its exports to the U.S., while reducing levies on some American products to zero. European Commission President Ursula von der Leyen hailed the agreement for the stability and predictability that it will offer businesses and consumers. U.S. energy stocks moving higher on the back of the deal as Trump said that the EU agreed to purchase $750 billion in American energy products and invest $600 billion in the U.S. on top of existing expenditures. U.S. defense stocks also on the move as the EU agreed to purchase vast amounts of military equipment from the U.S., according to Trump. Plus, investors are gearing up for a crucial week of earnings reports. Big tech heavyweights, Apple, Amazon, Meta, Microsoft, they're all set to report. Those four companies worth a combined $11 trillion will give investors a key glimpse into the health of businesses ranging from electronic devices and software to cloud computing and e-commerce. A strong showing is critical to sustaining the S&P 500's rally, with Meta and Microsoft among the top 3 point gainers in the S&P this year. And all eyes will be on the Federal Reserve as well this week as the central bank meets in Washington ahead of its policy announcement on Wednesday. The Fed widely expected to keep rates on hold this week despite immense pressure from the Trump White House to cut interest rates. In addition to the Fed decision, investors will digest data including the July jobs report, GDP consumer spending, PMI, and ISM manufacturing. Well, in case you didn't gather, it is going to be a very, very busy week between the Fed, reaction to the trade deal, and all of the earnings that we mentioned. Now, ahead of all of that, we are seeing a slight bump in the stock futures this morning. The Dow indicating a very slight increase at the open. We're seeing a little more strength in futures for the S&P 500 and then the NASDAQ as well. And remember, we have had a streak of record closes for the S&P and for the NASDAQ. So if there are more gains today and then for the rest of the week, we could presumably see more records for those averages. Let's get to our top stories of the day. Now, stocks rising on trade optimism after the U.S. and EU agreed to a deal. And earnings season's ramping up with more big tech earnings out this week. Plus, the Federal Reserve widely expected to hold interest rates steady at the July meeting. Joining me now, senior reporters Brooke DePalma, Josh Schaefer, and Ali Canal. Brooke, let's start with you, because as we've been talking about in recent days, we don't necessarily see a one-to-one correlation between these trade headlines anymore and the broader market. But certainly we do see individual stocks and individual sectors that are more directly impacted by all of this that are seeing a movement, and that includes some of the industries that you cover.
Yeah, absolutely. What we're seeing here is stocks roughly flat. And you're Denny saying in a note this morning that the financial markets anticipated the latest deal and the reaction to it is likely to be relatively muted this week. Of course, investors are thinking big picture here. They're not just now solely focusing in on these latest trade deals, especially with the EU, but rather they're looking out to these tech earnings, which will be, worth $11 trillion of companies like Microsoft, Apple, Amazon, as well as Meta here. And really what they're looking forward to is these companies reporting their outlook for what this could look like at the rest of the year. Is Apple able to overcome these latest trade headlines? Will they be able to ultimately get in on this AI revolution? And ultimately, will their earnings beat despite all this noise that they have been in focus over the past second quarterly reports? Of course, in addition to that, once again, AI will be in focus. And largely what we've seen here is just this push away of investors solely focusing on these trade headlines, but rather focusing on exactly how companies, key companies like Delta, like Levi's, as well as others, including Starbucks this week, have been able to overcome this environment with so much uncertainty, especially around the consumer.
Hey, Brooke, talk to me about the liquor companies here this morning and the action that we're seeing there.
Yeah, what we're really hearing from key consumer groups around spirits as well as wine is this hope that we're going to see the 0 tariff. Of course, Brown-Forman, Diageo, Pernod Ricard, those were companies that were concerned about that 100% EU tariff that was speculated to go into effect. Now they're hoping for those to sort of back down. And investors certainly trying to understand and digest, in this new environment environment where we're looking more at that 15% baseline. They're also at the same time hoping that that tariff come down to zero for key distillery companies like a Brown-Forman. Ultimately, that whiskey headline that went into, that made headlines rather a few months ago, where there was lots of nerve about that 100% tariff rather. Now we're seeing that slowly fear sort of go away.
And, you know, when we talk about also the sort of earnings optimism that's in the background, even with the trade stuff at the forefront, I guess, Josh, that's one of the reasons that we saw John Stolfus, already a big bull, got a little more bullish.
Yeah, so John Stolfus over at Oppenheimer, Julie, the chief strategist over there, coming back out and saying 7,100 for the year end for the S&P 500. Now, that was his previous target before the April tariff turmoil that sort of sent us way down, right? S&P 500 fell 19%. Peak to trough there, but he came out on Sunday night now saying 7,100. He is at the top of the chart that you're looking at on your screen there. Stolfus saying earnings per share of about $270 to $275 this year, a PE of nearly 26 times next 12 months earnings, which would be quite highly valued and something that we talk about quite a lot here. But Stolfus essentially arguing that with most of the trade uncertainty now past, you take a look at these earnings, as Brooke was sort of just hitting on, you look at the guidance that you've seen over the next 6 months, even into 2026. I was looking through some of the FactSet numbers over the weekend. I mean, over the last month, you've had earnings estimates for the next 2 quarters and the next year actually move higher. So when you think about what these tariffs are meaning for corporate profits, they're not expected to really compress corporate profits, at least at this point. Remember, we're only a third of the way through earnings season. But someone like Stolfus takes a look at what he's seeing in the market with the rally and seeing sort of this bubbling continue to brew higher, right? I hate to use the word bubble, but starting to brew a little bit higher. And he says, all right, I think the market can continue to trade at a high multiple and probably be supported as well by some continued earnings growth at the end of the year.
I think we can use the word bubble sometimes. Josh, it's okay. I mean, Allie, you used the word euphoria, which I think is another version, right, of bubble and whether we're seeing bubble behavior. You looked into that in a story you wrote over the weekend. And, you know, there is this view of what Josh is saying and what John Stolfus is saying, that there is earnings growth to actually back it up. But what were the folks that you were talking to saying?
Yeah, so Citi has a great indicator. It's called the Levkovich Index, and this is based on hard economic data and really stats out there in the market. So margin levels, short interest, and options pricing. Now that hit a level of 0.65 on Friday. Now this was above the 0.49 that was seen in the week prior, and the threshold there is 0.38. That signals euphoria, and we've seen in the past that markets can really trade in this euphoric territory for a long time. The problem is that when you have a lot of optimism in the market, that makes the fall, the eventual fall, hurt a lot more. And that is something that I spoke with Citi analyst Drew Petit about. And he told me that, you know, at this current moment, we have speculative trading, we have the rise of meme stocks. All of that is making strategists a little bit on edge about how optimistic markets currently are. At the same time, though, when we talk about this bubble activity, this behavior from the part of investors, if you look back in history at the dot-com bubble, what we saw in 2021, we're in a different spot today. And a large part of that is because of the earnings growth that you mentioned. That's not to say that there aren't some cracks underneath the surface, particularly when we look at some of those consumer names that are more exposed to lower income consumers. We have seen some softness in demand there, but overall, we are seeing solid beats. According to FactSet, we're continuing to rise when it comes to long-term earnings growth, not just for 2025, but also 2026 and beyond. So that is all leading to a lot of the optimism that you're seeing in markets right now, and also a lot of the analyst price targets that we continue to chase higher and higher as we continue to see these record highs.
And let's also push ahead to the events that we're looking at for this week, right? The two big things being the Fed and, yes, we have a lot of economic data. We'll leave that to the side right now. But the Fed and all of the big tech earnings that we're going to be getting. Allie, I know you as always and all of us are watching that CME Fed Watch tool to see what expectations look like.
Yeah, markets at this point are pricing in nearly 100% certainty that we will continue to remain on hold. But when we look out into the future, markets are still pricing a September rate cut. The odds are now at around 60%. About a week ago, we were closer to 50%. So there's a little bit more conviction there that we could see that 25 basis point cut in September. They also believe that we might see another 25 basis point cut in December. So right now, if we look out over the end of 2025, markets are pricing in 2 rate cuts. Now, strategists that I speak with, economists who I talk to, they're a little less convinced that we could see those 2 rate cuts. Potentially that could push us out into next year. And a big part of that is tariffs. We've been getting a lot of those trade deals coming in. We know that the 15% baseline seems to be the starting point here for President Trump. But Lori Calvasina from RBC Capital Markets, she wrote in a recent note that tariffs are going to hit in the back half of the year and 2026, especially with a lot of these companies that are exposed to the consumer. So if tariffs start to hit on the consumer side, those corporations, at what point are they going to start to pass on some of those price increases to their buyers? We haven't seen that at this point, but that's not to say that we won't in the future, and that could obviously impact what the Fed does down the line. So we're watching the data very, very closely, but we're likely not going to see data that points to a solid, like we're at the point now where tariffs have made their way through the system. We're likely not going to see that at least for another few months.
Right. Thanks, guys. Appreciate it. Brooke, Josh, Allie. Tesla CEO Elon Musk says the company has struck a deal to buy semiconductor chips from Samsung. Samsung confirmed it has this $16.5 billion agreement that it reached over the weekend. Didn't name the partner company, but obviously we put 2 and 2 together here. Tech editor Dan Howley joining us now with more. Hey, Dan, $16.5 billion sounds like a lot of chips that Tesla is buying. Talk us through this.
Yeah, this is to kind of help out with the whole self-driving vehicle kind of push that Tesla is going through right now. They currently source chips from Samsung. They're going to be then switching over to TSMC for another chip. That's the A15. And then they're going to be going back to Samsung for this A16 chip that's part of this larger push. And he said that he worked out with Samsung to be able to walk the line to optimize some of the manufacturing of the chips. I don't really know how that kind of works out, but we'll see. But this is, again, part of its larger push. It's a big deal for Samsung. They've been struggling as of late. And so getting this big foundry customer for this, huge contract is certainly something that they're going to be kind of championing and kind of using to build out their expertise going forward.
What does this say, Dan, that Samsung got this and not one of its competitors? Are there other companies, in other words, that could have provided these kinds of chips?
Yeah, I mean, look, Samsung, like I said, already does one of their chips. Mm-hmm. I think what it says is TSMC has a lot of customers, and they might not necessarily have the capacity or not to meet what Tesla requires for their needs. Obviously, TSMC builds for AMD, NVIDIA, Apple, a slew of companies that are just constantly seeking more chips. And so there's not necessarily a lot enough to go around for everyone at each time. And so it could be that Tesla was just looking for a manufacturer that wasn't as kind of overwhelmed at the moment, or not necessarily overwhelmed, but so in demand. And so that could be why they went with Samsung, along with the fact that, like I said, they used them before.
Right. That's interesting, that idea of capacity, which we know has been an ongoing one amidst this AI arms race to get those chips out the door. Dan, good to see you. We'll see you later in the show. Thank you. Coming up, we catch down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We are watching natural gas companies, Bitcoin, and Heineken. First up, shares for liquefied natural gas producers jumping in pre-market trading after the European Union agreed to purchase $750 billion in energy imports from the U.S. over 3 years. Cheniere Energy, Next Decade, and Venture Global were among the biggest pre-market gainers. The agreement part of a broader EU-U.S. trade deal that was reached over the weekend. Next up, Galaxy Digital completing a sale over the weekend of more than 80,000 Bitcoin for an investor in a deal valued at more than $9 billion based on current market prices. The sale, one of the largest exits to date from the digital asset market after a brief drop Friday. Bitcoin's price has since rebounded as of this morning and is now trading over $118,000. And finally, Heineken reporting a decline in beer volumes in its most recent quarter as retailer disputes across Europe continue to affect the Dutch brewer. The company now sees sales volumes that'll be broadly flat for the full year as a result of those ongoing disputes. The shares down 7%. At the same time, Heineken cheering news of a trade deal between the U.S. and the EU, adding that it is weighing options to deal with challenges in the long term. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, bullish calls from Wall Street as John Stolfus from Oppenheimer reinstates his street-high S&P 500 year-end target of 7,100. My next guest, though, warning that August could see some trade-related volatility return as U.S. tariff rates remain well above their pre-2025 levels. Let's bring in Tim Urbanowitz, Innovator Capital Management Chief Investment Strategist. Tim, good to see you, as always, here. And obviously, we got more trade headlines this morning between the U.S. and the EU. As you well know, though, of course, even with these trade deals, tariff rates now are a lot higher than they were pre this second Trump term. And do you think that investors have sort of fully reckoned with that?
Well, Julie, it's great to see you. And I think when we look at the 15% rate that was set over the weekend, it's certainly going to have an impact. But I think the good news is it's workable. And if we start to see similar deals with Mexico and Canada, a lot of this trade rate related uncertainty will be behind us. I think the thing that we need to be cautious of right now, and I think a lot of investors are falling into this mindset, Julie, that we've already seen the impact of tariffs on the economy and the markets. And we just don't think that's true. With all the uncertainty that you saw post-Liberation Day, I think a lot of companies were very hesitant to just go ahead and pass price increases onto their customers because they didn't know if those tariffs were going to be temporary. They didn't know if they were going to be going into effect for a very long period of time. So they didn't want to lose market share. They didn't want to lose customers. But that's going to change August 1st. You're going to start to see a lot of those price increases passed on to consumers. And for us, that's still a big question mark. What does that do to CPI? What does that do to the growth of the economy? And still a big question mark. And we don't want to just fall into this complacency.
Well, and if they're just going into effect on August 1st, as our reporter Ali Knau pointed out earlier, it's going to then take still maybe a couple months to figure out exactly what that pass-through is going to look like, right?
That's exactly right, Julie. And I think that is why you see such pushback from Powell to Trump's demands to just cut interest rates. There is a lot of uncertainty. There is going to take time for these tariffs to make their way into the economy. It's just not going to be a snap of a finger and we see what the impact is. So I think the Fed is in a very good spot of wait and see. Let's see what these price increases look like. Let's see what it does to CPI and see what we need to do. Because the reality of it is we just don't know what that looks like. I think, you look at the back half of the year, the good news is, the first half has been so driven by policy changes from the Trump administration, big things that are going into effect. We go into the back half, not as much so. So we can return to the focus on fundamentals. But I think the main message, Julie, is we just don't want to get complacent. We still need to be alert and not just assume because we are getting these deals, everything's back to normal.
I believe, even given all of that you think that the place to be right now is still, we've got these more big cap tech reporting this week. You think that investors need to be in there. Is that a place that is going to continue to be sort of more insulated from the trade headwinds?
Well, that's exactly it, Julie. I think the tech sector as a whole is very well positioned. They don't have as much exposure. Some companies not much at all to a lot of the tariffs, which is very important. They're still going to benefit from a lot of policies coming from like the one big beautiful bill. They're going to benefit there. But I think at the end of the day, it comes down to fundamentals, and earnings are very strong. Every tech company that we've seen report thus far in the S&P 500 has beat on the top line and the bottom line except for one. So that's very good to see. They're delivering. Growth estimates are high, especially if you dig down and look at some of the mega cap names, Mag 7 looking at 16% year-over-year earnings growth. So it's not an easy bar to clear by any means, but we think they're very well positioned overall. It's definitely a place you want an overweight to in the portfolio.
And Tim, when you look at the string of records that we have seen from the S&P and from the NASDAQ, how long do those kinds of streaks tend to last, especially as we see valuations kind of pushing up here?
Well, Julie, the tricky part is in valuations aside, because if you look at all-time highs historically, what you tend to see is they're clustered together. They come in bunches. You look at the bull market from 1989 to 2000. The S&P 500 hit a new all-time high every 9 trading days. Very similar to what we saw from the bull market starting in 2013. So they tend to be clustered together, regardless of valuations, how high it goes. You need to stay invested. So you definitely want to be in this market. At this point, you can't pull out, but I definitely think it's time to start thinking about risk management, how you're managing risk in the portfolio, because you just don't know, when some of these headlines will hit and what that looks like.
What does risk management look like for you right now?
Well, Julie, as we've talked about many times on the show before, a lot of the advisors that we talk to, they have turned to these options-based ETF strategies like buffered ETFs. And the reason that they are gravitating toward these strategies is they provide a level of certainty. So they'll give you access to the broad market, but at the same time, you have a known buffer against losses on the downside, whether that be 9%, 15%, 30%. So you're able to keep your foot on the gas pedal in a sense with exposure on the upside up to a cap. But you're also making sure that if we do start to see, some negative news creep in, valuations start to normalize, that you do have that protection. And we think that's very important, especially given the risks of inflation that we see in this market right now.
Tim, good to see you. Have a good one.
Great to see you too, Julie.
Coming up on Yahoo Finance, it is Opening Bid. Executive Editor Brian Stassi, who also doubles as the host of that program, is with us now. Brian, what's coming up today?
I do double. That's a lot of things. Maybe I triple
you wear a lot
things,
of hats.
Julie. Yes, I wear a lot of hats. But we're going to talk trade. Got that Fed meeting, big week of earnings this week from big tech. But I'm very interested in this new $16.5 billion chip deal between Tesla and Samsung. Julie, to me, it signals Elon Musk making a big bet that the future will be all about robots and driverless cars, and maybe humans play second fiddle or no longer exist.
Wow, humans no longer exist? That's where we're going with this, Saz?
Coming out hot today, Julie. It's Monday.
You are coming in hot. I'm for one, I'm all in on the humans.
You would be.
All right, that does it for Morning Brief. Much more ahead on Yahoo Finance with your human host, Brian Stassi.